I'm Melissa Lee. Tonight's top trades. Bet your bottom dollar the buck surging today is the bottom in for America's currency. One trader makes a case to the macro maven, Peter Schiff. Plus, when rates and stocks collide, we'll tell you who loses when these two market forces come head to head and how you can protect your portfolio from the shockwaves. And BlackBerry Brawl Research in Motion selling off ahead of its earnings report. One of our traders is buying on this dip, but a top analyst screams sell. The ultimate street fight is ahead. Live from the NASDAQ market site, this is America's post-market show. Pete, what'd you make of the dollar move today?
Well, I think when you start to see the dollar make that kind of a move, obviously you immediately look to the commodity space. You see oil early on taking a hit, but actually rallied off of the lows. But gold absolutely getting crushed on the day. That really pulled down the markets along with the commodity space that was actually reeling back as well. I'm actually impressed the fact that the market held on as well as it did. And looking at the volatility index, still holding in that level where we've seen support, 17, 17.5. It seems like buyers are willing to come in and get that premium at those levels. And yet we aren't seeing that panic. It's not spiking through 20. Didn't even get close when we finished underneath 18.
What'd you make of the dollar advance today? Because we had euro weakness, of course.
You know, look, we're back to Monday's levels. This is not a big deal. And I look at the treasuries. We're going to have a lot of talk about this, but industrial production, Empire State, retail sales early in the week. I mean, you know, why do you question the dollar's move? It's because of the data. Remember, the last week payroll number, when you know we got a much poorer number than we expected, the dollar dived. So this is the dollar rallying on strength. This is the Treasury curve that's trailing off on the back of strength. And I think a lot of people want to point the finger at the bond market is telling equity something, when in fact, I think it's totally the other way around.
Well, the reason why I say maybe the dollar is because of euro weakness is simply because when we hit the dollar highs on the session, we saw the stock market at the session lows. I mean, that's exactly when the S&P 500 turned negative on the day. And granted, it's not a huge move on the day, but that was the relationship in today's session. Karen, how did you read it?
I got to say, I agree with what Timmy's saying, because I do think the data is good. I like to see those numbers out this morning. And I'm a little bit concerned that rates are moving so quickly. That doesn't really thrill me. But so we did buy some out-of-the-money protection. I don't want to sell the stuff that I have. I like the stories. I like the recovery. I do believe in that. But when the VIX hit lower today, like Pete said, then I think it was a good time to buy some S&P out of the money, you know, 2 or 3% or more out of the money, just so I can sleep better at night with my longs.
It's a great time to do that for sure. I mean, number one, obviously the options, the insurance is costing you a whole lot less money. I mean, that's the first thing. And right now we're seeing that there is support at that level, so you really aren't going to see a whole lot of decay come out of those options. I mean, people are going to step in and protect their portfolios. It's a sensible thing to do here. The other point, and I think it's a great one that you made there, is that really we've been seeing the real excitement has been in the bond market over the course of the last couple of weeks. I mean, so the dollar's move today, I don't know. I think we've been.
But is the bond market somebody rolling out? I mean, getting out of some of these bonds, pushing it out, and looking to put their money somewhere else, i.e. right into the old equities themselves. Seems to me like we've been seeing this rotation where you're seeing money flows into various sectors, a different sector almost every day. As we get into the end of the year, the bonds going down, and you're seeing those yields start to move back up.
Take a look at this chart of the day, because maybe that will shed some light on what you're saying and also what Timmy's saying. The folks over at Bespoke put this together. They took a look at when the S&P 500 and the 10-year yields actually hit 6-month highs. That did happen. If you take a look at any period, 1 week, 1 month, 3 months, 6 months, you do see stocks then decline. What do you make of that, Tim?
Well, look, I mean, December 1, stock market went up 2.5%, 2.2% on the S&P. Yields backed up 17. On the 24th, we had the market go up 1.5. Yields backed up 16 points. This, to me, is totally a story of the world getting healthier. This is not a run for the door. Also, you know, I talked to a bunch of bond market guys because we all want to know what's going on. They're telling me there's very little volume. Liquidity in the 10 years right now is probably 1/5 to 1/6 where it usually is. It's year end. A lot of guys have just thrown up the shack. I think that that's an overdue on a lot of this. I think bond yields are moving because they're getting pushed around. You don't push the Treasury market around typically. It is getting pushed around a little bit right now because liquidity is not that high.
Right. Everybody's on holiday so far. All right, let's bring in BK on the prop desk. Brian Kelly, what did you make of the dollar move today? And, of course, we have some major currents out of Europe, and I believe the Swiss National Bank is meeting tomorrow, which could impact also the direction of the euro and the dollar tomorrow.
Yeah, and we also have Spanish 10-year and 15-year auctions, which overnight could be a market mover, at least when we wake up. You know, listen, I agree. A strong dollar isn't a bad thing. It's a good thing as long as it signals a strong economy. And that's how I took this move today. The euro concerned me a little bit because it was such a strong move down. There are some problems there, but actually a weaker euro is going to help the European exporters. So I wouldn't say, you know, we've got a big problem here. I actually think it's pretty good.
All right, so let's bring in another voice on this whole debate. The stronger dollar is the story today. So let's bring in Peter Schiff, who is actually predicting the dollar's demise. Peter, of course, of Euro-Pacific Capital here. He joins us now. Peter, what's going to actually precipitate this? Because so far, you know, the dollar has proven to be a safe haven currency, and so we have not seen a collapse, nor are we seeing the beginning of one.
I don't think there's much safety in the dollar. I think, the dollar moved up a little bit today on the back of higher interest rates. But, it's not. The Fed isn't getting aggressive in raising short rates. It's just the longer end that's really moving up. And that's not because the economy is improving. I think that's because the bond vigilantes are coming out of their coma. They realize the Fed is out of ammunition here. All they do is they try to goose the economy artificially with cheap money. They brought interest rates down to zero. They couldn't do anything else, so they tried quantitative easing to try to get the long rates to go down. Instead, they shot up instead, so it's a complete failure. Interest rates are headed a lot higher, and all we're going to do is keep borrowing and printing money. That's not good for bonds, and it's not good for the dollar. This little dollar rally will not last, but I think the bear market in bonds could finally be here, and there could be a lot more legs to it.
Hey, Peter, it's Brian Kelly. During the Depression, the countries that did not expand their money supply actually didn't recover as fast as the countries that did. That's exactly what this Fed is doing. So it's similar to a stock or a company issuing stock to buy growth. That's what we've done here, and that's what the market's signaling. So if we get that growth, then the dollar should appreciate, particularly if rates are going up.
Maybe it's like a penny stock issuing shares to dilute everybody. You're not going to get economic growth by printing money.
But we
get economic growth.
We are getting economic growth right now.
No, we're not seeing any growth. Where are you seeing it?
What about retail sales? Look at Home Depot.
How about this?
Retail
you tell me where we're not seeing it.
Spending money is not economic growth. We're borrowing money and buying products.
How is spending money not economic growth?
Peter, the fact that we're spending...
What is economic growth?
Hold on, guys.
Economic
we're all talking over each other. We can't hear anyone. Tim asked a question.
Economic growth is capital investment. It's production of goods, not the consumption of goods. Going into debt to buy more products that were made in China, maybe it shows the Chinese economy is growing, but not ours.
Nobody's going to produce goods if there's nobody consuming them.
I'm going to blow the whistle here. Hey, guys, Tim, ask your question. Tim was going to ask a question, and then Peter's going to respond.
There's a lot of people who like to hear themselves talk out there. The bottom line is, Peter, first of all, where are the Chinese going to go? You're talking about rates are backing up here. Where aren't they going up? You show me a country around the world where rates aren't going up. You want to be in Europe? And you tell me what happens when the 10-year goes over 4%. The Chinese will be first in line to buy the 10-year. You tell me.
No, they won't.
Where are rates going to go, Peter? Are rates really going to go up to 6% next year in this world, in this environment? Where are you going to buy that's a better deal than Treasuries at 4%?
Treasuries are a lousy deal. I think rates are going to go through.
What are you buying then? You've always got a lot to say against the dollar and the U.S. government. What are you buying that's not gold? And give me something specific.
Well, I am buying gold, but I'm buying stocks all around the world. I'm buying commodities. If interest rates are going to go up, but the country that's going to be hurt the most by higher rates is the U.S. because we have the most debt.
The U.S. has the most ability to issue debt. The U.S. is the largest bond market by a factor of 10.
That's
the problem. You think people are going to run away from the table just because yields have backed up 5%? This is actually a buying opportunity.
But with whose money? Don't buy with. If you want to buy with your money,
the Chinese have done better than anybody in this bond market. The people that you say are going to run for the door are the people that have made the most money and have the most to lose.
We've been in a bull market in bonds for 20 years. You think that's going to go on forever?
All right, Peter, I'm going to insert myself into this conversation because I want to actually get to the bottom line here. You said you're investing in stocks around the world. Can you give us a name of a stock that's going to yield more than, say, a 10-year?
Well, just about every stock that I buy that's not a mining stock yields more than a 10-year Treasury.
Give us some names, Peter, because we want to be constructive in this conversation.
Well, I don't have to give you names. I can give you ideas and themes. You want to try to stay invested in companies that are exposed to the growth that's taking place outside the United States. You want to look at the new emerging consumers, the people who have been saving their money and producing. Those are the consumers of the future. Americans are the consumers of the past. We're broke. Right? So you have to have businesses that are going to benefit from this change in global wealth as the world moves away from a U.S.-centric model towards other nations. So I'm focusing on Asia, where people are working hard, where they're producing, where they're saving. I'm focusing on countries that have a lot of natural resources that they're able to export to take advantage of the strength in those markets. And I'm avoiding anything that has to do with the American consumer. Either they're spending money or they're having to pay back the money that they borrowed. We have a lot of problems that we have yet to confront in this economy. The real U.S. collapse wasn't in 2008. It might happen in 2011 or 2012.
Peter.
Yeah.
We're going to continue this conversation a little bit later on in the show. We're running a little bit behind here. But, of course, Peter will be back later on with his top ideas for 2011. At that point, Peter, absolutely, we'd love to have you expound on some of those themes for 2011. And later on, Brian Kelly will go to the wall to defend the dollar and a bonus buck trade. So this dollar debate will continue throughout. Meantime, let's move on to our next trade here. No holiday cheer for banks as analysts slash fourth quarter estimates for brokers. Nomura specifically knocking both Goldman and Morgan Stanley down on the estimate front. A Goldman analyst took down EPS for Morgan Stanley. Interesting how it goes around and around in a circle. But in terms of the estimates, I mean, they are now well below the street's consensus numbers, really throwing into doubt whether or not the volumes have been decent into the fourth quarter.
Right, they are. It was a big cut in earnings estimates, although they did maintain the target the same. So it does sort of make you wonder. You know, historically, these kinds of companies have very lumpy earnings anyway, so I don't really read that much into it. I still like J.P. Morgan for obvious reasons, but also for fundamental reasons as well. I don't think that just because it's December or year-end or rotation, any of that really matters to me. It's really that I do think the economy is getting better. I do think we'll see loan growth, and I do think we'll continue to see credit quality improvement. That's good enough for me.
Hey, do you still like Morgan Stanley? I mean, what
I do. I still own Morgan Stanley. I own Citi, and I like both those names still. I think if Citi does push back up towards $5, I would probably exit and start to look other places. But, you know, the bang for your buck right now in Citi, I think there's a fairly decent safety net to the downside. I think there's still some upside. I still think Morgan Stanley is easily a $30 stock. Now, when that happens, it might take another quarter or so, maybe even in the first half of next year. But I think there's plenty of upside still, and I think those regional banks, we talk about the KRE, that's an area where you've seen starting to see an explosive move to the upside, and the January option activity tells me there's maybe even more upside to come.
Well, you know, I mean, first of all, to your point, the investment banks and brokers do have lumpy earnings, but that also means that they traded attractive multiples because of it. I think you can still take a look at Morgan Stanley, and JP Morgan's just a cheap stock. I mean, they're obviously in a well-positioned, given some kind of an economic recovery here, but they're trading at less than 10 times earnings.
A Goldman upgrade or a Goldman downgrade, in the case of Morgan Stanley today, was a downgrade, is typically always an opportunity for traders. So again, because Goldman's clout, they push stocks around, people listen. This stock moved down. I go back to Karen, Mike, this is a valuation story. Morgan Stanley at 0.8 times book is a stock you can own. But it's been a range trade. So between 24.5 and $27, that's where this thing's traded. That's what financials have done for the last 6 months. This stock, to me, looks like it's trading downward. I would not touch this stock till it hit 25 at around 26.20. I think you can wait a bit, but take advantage of that sell because this is a great.
I think you do need to touch the stock, and the reason you'd want to is because you'd want to get in here at volatilities at these levels, buy yourself the protection that you'd want. Go 3 months out, but that way you get the upside.
A quick and final point on the brokers and the banks. If their business is cyclical and it does bounce back and forth, wouldn't you rather buy them after they've had a tough period, which they obviously have?
Right.
This is obviously a better time to enter than after they've really had a rally and everything's looking like it's going to be roses from now on in.